Company can benefit through structured financing is because it can optimize its capital structure and really find the right instrument for the needs of the company. There are many ways of doing that. Just to give you a few examples, what we very often invest in portfolio companies is structured growth equity. So it's an equity instrument, but combining some other features that you would see in debt financing. This could be a put option, for example, to ensure that there's an exit at some stage in the future, but also a preferred return, which means that we would get our money back before at exit, before the founders get the money. But this is just in case of a really material underperformance of the company. On the other hand, we also want to incentivize the founders to even work harder and develop the company in the right way. So we are also very much open. This is what we usually do in our portfolio companies. We also give earnout structures. So this is a quasi option that the founders have to get additional shares back and therefore increase the valuation retrospectively and have a higher portion of the company and the exit proceeds. Our value proposition for structured financing is that we really try to understand the financing needs, the expectations of the founders of the company, and then really try to tailor something exactly around that. The big benefit for the company is that the company can optimize its capital structure, meaning that by combining different instruments, equity and also some hybrid instruments, for example, mezzanine or some convertible loans, we can achieve that the average cost of capital for the companies is reduced. An interesting use case, we recently invested in a portfolio company, and when we started the discussions and the negotiations, there was quite a bit of a gap in the valuation expectations. So obviously, and also secondly, there was some concern about the exit, when it will happen, how it will happen. So we kind of went into our toolbox and we structured it in a way that we offered the founder an earnout so that he can get some shares back if he exceeds certain milestones, certain returns. Another interesting use case was a company that actually performed quite well, and initially we invested preferred equity. But then when the company needed more capital to accelerate further growth, the idea was to invest an instrument which reduced the average cost of capital for the company. So preferred equity was not the right tool anymore. It was more a mezzanine type of instrument with some warrants, which is cheaper for the company and which was seen very positively by the company because this is exactly what we want to do, is finding the right instrument for the right situation. And we as BlackPeak, we have the flexibility to do that.